we here.
We good? Okay, let's do this. So we're on series 4 or 5? Series 4 of the Level Up series. And today what we are talking about is mortgages. So we've looked at education, we've looked at networking, we've looked at credit scores, and now we're talking about mortgages. So that will kind of overlap somewhat with credit scores. Aisha's in the hot seat being our most recent home buyer. So we're going to be speaking to Aisha and then seeing how we can mix things up with what she knows and what she doesn't know and what she's still yet to find out. Aisha, are you ready?
Yes, but we didn't do it.
Sorry, Aisha's in the hot seat.
There we go.
All right, Aisha. Oh, no, I'm still on Charlene's questions. Give me a mo. Let me flick back to mine.
Do you want me to go first?
Yeah, you go first.
Were you aware of all the hidden costs when it comes to a mortgage?
No,
Do you know the difference between fixed and variable mortgage?
I do now.
Can you get a mortgage being self-employed for a year?
Plead the fifth? I mean, I don't know.
How many times your income can you typically borrow?
It depends on I think it depends on your profession, but I think it's between 3 and 5 times.
Oh.
Well done, Aisha. Do you feel you fully understand the mortgage process and everything it entails?
Yes.
Could you confidently purchase a buy-to-let home?
No.
Are you aware of the term LTV?
Yes. Loan.
Yes, loan. Okay, cool. We'll leave it there until later on.
Loan to value ratio.
Well done. What is the average term of a mortgage, years-wise?
It used to be 25 years, but now a lot of people are going for more 30 years.
Well done. She does it. We should have done someone else. She's too fresh to this. Can you name at least 2 types of fees incurred in the mortgage process?
Solicitor's fee, stamp duty fees.
And what fees, sorry?
Stamp duty, land tax.
Stamp. Okay, fantastic. Well done, Aisha. Aisha, I feel like she's too fresh to this. Like I just bought a home, so I just found out. So it hasn't gone anywhere yet.
And Aisha does ultimate research for absolutely everything in life. So she would have done scrutinized all those small prints and, you love it, don't you, Aisha?
I'm one of those annoying people that, when I come to buy anything or do anything, I'm like, right, what about this? What about that? What about this? What about that?
What about that?
Yeah, what if this goes wrong? What about that? Have we thought about this? Have we thought about that? So yeah.
That's a good person to be, though, isn't it? So well done to you. I'm sorry, I'm all over. So we're talking about mortgages because I was about to say naturally, but I don't want to put it as stereotypically. Well, it is stereotypically naturally, but it's obviously not an obligation. But a lot of people get into the home buying game after they've kind of established themselves in their career and they've kind of had a nice lump sum of savings and they know where they're wanting to live. So that's why we've covered this as part of the Level Up series. It doesn't mean that you're not leveled up if you don't have a mortgage or if you're not interested in getting one, but we've just covered it as part of the bigger picture. So Aisha, you said one of my questions was, could you confidently buy a buy-to-let home? And you said no.
I said no.
Yeah. So what are you finding the differences are between the buy-to-let homes and the residentials?
I guess because I didn't look into buying a buy-to-let, I don't know whether the process is different. I know you have to get a different type of mortgage, and the fees associated with those mortgages are different to account for the fact that you're getting an asset to then make money out of rather than being your residential home. But I'm not sure how the actual process itself or the contract or the fees differ from a residential home. I just know that it's slightly different, if that makes sense.
Yeah, makes complete sense. And I think the main point that you made is it's about a purchase to rent out rather than a purchase to live in. So I don't think you can actually even get a buy to let until you've either had a residential home or it comes next. So it's not your first purchase. A buy to let wouldn't be your first property to be owned. That would be after you've established yourself as a residential buyer. And I think that's because of the risks and stuff involved with that. Should we talk? I was going to go back to the questions, but do you think we should kind of talk more through the process, because it is quite a long subject and it can kind of go into different areas, and each area in itself can be quite a lot of detail. Should we go through the process?
Yeah, but before you carry on, you can be a first-time buyer with a first-time landlord. No, like you said, you don't know if you can. You said you don't know if you can be a first-time like buy to let. You can be a first-time buyer and be a landlord. So your first house can be a let house.
Oh, it can.
Yeah.
Oh, I didn't know that. It could,
big plugs to my cousin who's a mortgage advisor.
And I actually
sneakily told me a few
too
things.
late.
I know, right? We need to get on his lives really quickly. Seb, the mortgage advisor on Insta, and obviously told him we was doing this episode, and he sent me a few facts and stuff, and that was definitely one of the facts. You can be a first-time buyer, first-time landlord. I didn't get any more information about that, but you can. So if it's something you want to look into,
well, do you know what?
I see it as naturally the next step. Like you said, I see it as the next step, because unless you wanted to, like, would you rent your own place, rent the house that you're living in, and then, have rentees, I suppose, in the property that you own?
What, in the residential one?
Yeah. So if I was in a house that I was privately rented, would I want to privately rent my house and then buy a house for other people to live in? But it's possible. I see it, like you say, as the next step. Like, you would have your residential, and then you would buy another house for other people to live in.
Or purely for investment purposes, you could have that as an option.
Mm-hmm.
Yeah, I'm so glad that you said that, because that is of great interest to me. But obviously, I've already got one, so I don't. It would have been useful before that, basically.
Yeah.
Would have been useful beforehand. All right, let's go through the process. Aisha, you're the most recent home buyer. So talk to us a little bit about the process, and then we'll try and fill in the gaps, and Charlene can fact check us as well.
Yeah,
I'll try.
So yeah, I've completed literally within the last couple of months of this podcast. And I was quite lucky, actually, because the process was a lot quicker than what it usually is. It usually takes maybe 3 times as long as what it took for me. And it was another lucky thing that it was just before the lockdown of COVID, because otherwise I still wouldn't have a house now. But usually the first thing that you do is go and find a house that you like, essentially. Actually, let's roll back. The first thing you do is try and save yourself a deposit.
Yeah. Don't get your hopes up before you find the house you want and you can't get it.
Exactly. You need a substantial amount of money to put down as a deposit, to basically show the bank that you're willing to put some equity into the house initially, for them to agree to lend a mortgage to you, right? That's the first thing you need to do.
Can I say the first thing that I think, fact checking, you should do is speak to a mortgage advisor, or rather than the bank, speak to a mortgage advisor who will tell you how much it is money-wise that you would need to save before you go looking for a property. And like you say, it's better to look for the mortgage before you look for the property. But go ahead.
Oh, so you can speak to a mortgage advisor very early.
You can speak to a mortgage advisor with no money in your damn pocket. As long as you know, if you say like you need 20 grand or you need 40 grand, there's a big difference. So before you've got the 20 grand in your hands, and knowing that you need another 20 grand on top of that, then at least speak to a mortgage advisor and say, look, here's my income, based on loose terms, like you're saying, about how much, based on your profession, how much you would be entitled to be lent by the banks and stuff like that. So kind of get an idea of what kind of area that you want to live in. Very different if you want to live up north or if you want to live in central London. So speak to somebody who was going to know the market, have seen people like yourselves beforehand, and be like, okay, you fit into so-and-so category, roughly about this much, before you even to have any money in your pocket.
Charlie, you came through with these facts today. One second.
Deb come through with the facts today, okay?
Yeah, that's a really good point, Shah, actually, because there are different first-time buyer schemes and stuff that you might be able to qualify for if it's your first mortgage, and actually a mortgage advisor would be able to advise you on that.
Mm.
Yeah.
And what I didn't realise in terms of the amount you need to save, you almost need near enough double your deposit to cover the stamp duty and all the fees that are associated with it anyway. So you think, oh, my mortgage is going to be X amount, so I need 10% or maybe 5% if you're a first-time buyer of that. But actually, that's not entirely true, because you need to pay the stamp duty within a certain amount of time of completing on your purchase. Most solicitors want it before. I will come to that in a minute. And so you need to have that money with your deposit money. So don't just assume it will just be the 10% of the value of the property you're going for.
Mm-hmm.
Mm.
Yeah, good point, Shah. So yeah, then you look for your property. It took me and my partner probably about 3 years to find the property that we liked, because we couldn't agree on where we wanted it to be, what we wanted it to be, and all of that kind of stuff. And I don't think we figured out our finances early enough either. So our net was cast really wide. So we were just scattergunning our approach in terms of searching for what we wanted. And it wasn't until kind of I sat down with him and I said, right, we need to pick what our top 5 main priorities are with this house, and then what the remaining nice to haves are, because you're never going to find everything that you want in your first home, or in any home, to be honest. You need to kind of think about what things are like a deal breaker for you. Try and find those particular things in the property, and then if it has your nice to have things as well, amazing. But I'll give you a real life example. So one of the things that we really wanted in a property was a driveway, because we didn't want to have to.
Oh, you're really cutting out on my side.
Oh, can you hear me?
I can hear you.
Okay.
Yeah.
One of the things we wanted was a driveway, but we couldn't find a property that we wanted with a driveway near the tube station in a location that we wanted, X, Y, Z. So we had to. We looked for a property that didn't necessarily have a driveway now, but one could be built in the future when we had the money to do it. It's just trying to think of things like that while you're looking for a property in order to actually find a good one for you. And then after you found a property, the next thing is to put an offer in on the house for the amount that you want to pay. So 9 times out of 10, you don't put in the asking price, you go a bit underneath that. To try and get yourself a deal, because most people will put their houses on for sale for more than what they actually want for it, just to give themselves a buffer to negotiate. So then, you put an offer in, and at this point, you should be corresponding with the agent for the seller, so not the seller directly. And what did we do next? And then you kind of, if there's other people that are interested in it, you might have to go through a round of negotiations. So everyone has to put higher offers in, and then the seller picks who they basically want to go with and accepts your offer. And then you start the legal process, which is really, really long-winded for some reason, where you have to.
But you love that part, right?
I know, right? It's my favourite bit. Exchange contracts is the first thing you do. So that basically contractually binds the parties to selling the property at the price that you agreed to sell it at. But actually, no, that's a lie. Before you do all of that,
you forgot the non-binding part. You forgot the mortgage in principle.
Exactly. Yeah. So maybe someone else should talk, because I'm doing this all backwards. So you actually have to go through the mortgage process, which is the most important part that we're here to talk about today. So that was a bit silly. You need to go through the mortgage process. And what I'll say about that is you can go to an individual lending institution, like a bank, for example, so your NatWest, your HSBC, Barclays, that kind of thing, or you can go to a broker. And it's always a good idea to have a look at online comparisons as well of what banks are doing what rates, because you want to obviously try and get the lowest rate for your circumstances. Because if you've got bad credit, for example, you might not be able to get the best rate the bank's offering you. So you need to look at what your circumstances are compared to what you can get. But that's why I think a broker is a good way to go, because they can advise you, and a mortgage advisor, because they can advise you on all of those things. You're not doing it blind. and then that process is quite long as well, because you have to go through loads of credit checks. You have to give bank statements, you have to give proof of address, proof of identity, you have to give at least 3 months previous work pay slips to prove your income. There might be loads of other things that they ask you to provide if they have a look at your documents and say, oh, we need more evidence of XYZ, like your income or your outgoings. You need to say every single thing that you pay for as an outgoing and what's a commitment, which is really onerous, even down to the fact of we have a lottery syndicate going, which I think is about £2 a week.
And we're going to win. Can I just say that?
We're going to make it big. I think it's only like £2 a week or something as a friendship group. So everyone contributes £2. And no word of a lie, the bank came back to me and said, what is this £2? Why are you paying it? Is it a commitment? Over £2, because they want to make sure that you've not got any commitments that are going to get in the way of you paying your mortgage.
Yeah.
And that £2 might matter.
What did you say, Shah?
I said that £2 really might matter in the sense of paying your mortgage.
It really does. And if you don't announce it, it can be fraudulent.
Exactly. But I'm going to let someone else talk now because I've done a lot of talking.
No,
can I just say, in regards to, you did really, in regards to what we were talking about last time in terms of credit reports and stuff like that, there's a website called checkmyreport.com where you can go back and like we said last time on how things on your credit report can really affect your mortgage process. It can take you back to almost 6 years. And what's important is not your credit score, but like we said, the defaults on payments and stuff like that, in terms of how, you know, if you can't pay your £2 for your lottery fund one time and you default on that payment, then that kind of like sticks out. And it's 6 years, like that takes you back from, just to link it to our last episode. I know, right? I can't remember what I was paying for 6 years ago.
And this is the thing that a lot of people don't realise. Like back in the day when we were much younger, there might have been times where you didn't pay your mobile phone bill because it wasn't important to you at the time. Or, you know, you missed a payment for that Topshop account that you had and you didn't think anything of it at the time. Yeah, you didn't think nothing of it at the time. But then when you come to do something like buy a house, like we were saying before on the last podcast, it can really affect you. And this is one of the ways it can really affect you, because if the bank sees a default, they'll sit there and think, okay, how long ago was it? What was it for? How much was it for? Is that a pattern of their behavior? Am I going to get my money on the mortgage every month? Like, what's the risk involved? And that's all the stuff you do when you're applying for a mortgage. So it's really important to, even before you know that you have your deposit, you want to buy a house, that you know, right, I need to start getting, even from like 3 years in advance, getting my credit rating going and getting my credit score better, just from the get-go. So yeah, that's kind of like the credit checking process that you have to do as part of it as well. And the bank might come back with queries, like I said, on your bank account or on your credit scoring about why certain things are not very good and all of that kind of stuff. And then your bank will give you the mortgage in principle, and that gives you the green light to then proceed with your purchase. Because there is a time.
Which means, can we dumb down that term, which obviously means we're going to give you the money, ...
Yeah.
But we're not obligated.
Yeah, we're not obligated to give you the money, but we trust that you can, but you still might not.
That's in bit. So that's why you have that in principle to say, okay, cool, this is definitely looking likely. But even at that point, you can be swiped in by some other buyer who's maybe putting a higher offer, and the non-binding aspect means that the other buyer could potentially get your property even though you received that mortgage in principle.
Exactly.
Yeah.
And actually, that's a really, really good point, both of you, because what's the best thing to do is engage a mortgage advisor or a broker right up front and get your mortgage in principle ready before you're then looking to make offers, because a seller will take you more seriously if you're saying, I've got my mortgage in principle in place, So all those checks have been done already. They'll just be the final checks that the banks do. I'm ready to roll as quickly as possible because a lot of sellers want to sell quickly. And I'm better than that other person because of that. And I know I'm going to be able to proceed with the purchase. It's not going to fall through.
So basically, you're saying man's got that to the people.
Exactly.
Like, did you get that before you even found your property?
We didn't.
Hindsight.
Hindsight's a great thing, isn't it?
I know, but exactly. Now I know that's what I would have done before. But yeah, we didn't.
That's fine. And we actually got ours. So we got our mortgage in principle, and the seller was happy to sell quite quickly, which was really good because then it meant, even though we kind of bartered down the price and were quite fortunate because I think the property had been there for quite a long time. But something to note down is when you do get that agreement for the seller, you want to communicate with your broker or your agent and get them to ask the seller to take the property off of all selling sites, because that does give the other buyers the opportunity to swarm in and get your property. So as soon as you've kind of got that agreement, even though it's not legally binding, you want to say, okay, cool, can you please take the property down so that you have less chance of someone coming and buying your property that you've agreed
Kick
with
out
someone.
the competition.
This is it.
Yeah. Exactly that. But it's things that you might not think. You might, because as a first time buyer, you might think, oh yeah, it was accepted, we've got the house. But there are non-legal elements, which mean people can do things like that. So you have to be smart and say, okay, cool, if you're willing to sell to us, take that house off of the market and let's proceed as quick as possible.
Exactly. I remember you mentioning, Tate, until you sign the contract, the legal contract, either party can pull out at any point.
Yeah.
So there's no security whatsoever. So you could spend money doing on solicitors' fees, for example, doing searches on the property, and investing time and money into this purchase. And actually the seller just says, well, I don't want to sell anymore, or I've got a higher offer, or X, Y, Z. So
well, imagine you're doing that on more than one property. You're doing that on 2, 3, 4, 5 properties. Then all of a sudden I ain't got no more money for a mortgage anymore. I'm broke now.
Exactly.
There's nothing you can do.
Realign, because your energy is off. If you've lost that many properties, your energy is off.
You were never supposed to live in a house at all.
Yeah.
Hard for you, baby.
Trust me.
Please get a caravan, fuck it.
Better yet, why don't you get a riverboat?
Yeah.
I was just going to say that term when someone comes in and offers more money than you and the seller goes with them, that's called gazumping.
Yeah.
Yeah.
It's so funny because that word actually sounds like what it is. Like, oh, darn, gazumped.
Gazumped. So you don't want to be gazumped, hopefully. So you want to have everything in a row so you can exchange contracts as quickly as possible, and then start the last bit of the process. But we're here to talk about mortgages in particular, aren't we? So we won't go into the whole rest of the process with the legal stuff unless you think we should.
I mean, that's why we end up talking about subjects like this for ages. There's so much information, so many rabbit holes that we can get caught down.
Yeah. So maybe if we focus on the mortgage today, and then we can always do a follow-up session, talk around the area a bit more in terms of the process for buying a house.
Can we touch back on deposits?
Yeah.
So I know a lot of offers are out there for like 5% deposits or the 10%. Obviously, the more deposit you put down, the more of the house you own from the beginning of the process. So if you go with a higher deposit, you own more of the house from the start of the process. But it's also good to note down that if you go for the 5% over the 10%, you might be missing out on some of the rates that would be better if you put down 10%. So even though it's an option, if you can put down 10%, it might be preferred rather than putting down 5% because you'll get better rates in the long run.
Yeah, that's a really, really good point, actually, Tay. The more deposit you have, it puts you into a different bracket of mortgage products that are available to you at different rates. So even above the 10%, if you can give 15%, that puts you into a whole different bracket of products, mortgage products they're called, that you can be entitled to, or that a lender will provide to you, which essentially means you get a lower interest rate, so your monthly repayments are less, and what you end up thing over the whole term of your mortgage will be less as well. So it just benefits you in the long run and in the short term if you can put more cash up initially.
Yeah.
To save from when you're 12.
Sorry, what was that, Shah?
I said save from when you're 12. By the way, I've lost both of your pictures. I can't see any of you on the pictures. You're absolutely completely frozen. So I'm going in blind.
Okay, we can see you.
Yeah.
So something else I wanted to mention on deposits is more about savings, but it's kind of linked. So there are government ISAs that you can open, and I know we've spoken about this a little bit before when we talked about finances. But to save for your house, there are Help to Buy schemes that you can start saving in, and then the government give you money once you buy your property. But there are restrictions, so I'd say look into those about the value of the property and where you're buying it and all of that kind of stuff. You know, lifetime saving ISAs and Help to Buy ISAs and that kind of thing. But Martin Lewis,
you have to really go into detail, because I think the expectations might be a little bit higher than what's actually on offer. So in regards to like the Help to Buys, like there's only a certain amount of money that you can put in each year, and that will obviously equate to what you can get back from them that contributes towards the house. And it's not money that you're given directly, it's money that goes only to the solicitors when you're in the process of buying the house. And then you've got the lifetime ISA, which comes with its fair share of, if you take money out, then you're going to pay a high percentage to actually receive that money. So taking it out costs you to have that money back, which means that it might not always be your best option, but it would be if you started saving as early as 18. So if you started saving as early as 18, it's much more better option than being a 30-year-old that takes out that lifetime savers and then needs to take the money out and then needs to pay for the fact that you've taken the money out.
Yeah, exactly.
Another fact that I learned yesterday from one of Seb's lives is you can take out a mortgage from the age up to the age of 65. They'll give you a 20-year mortgage up to the age of 65. So you're never too old to get a mortgage or too young.
That's
You're not. It's not that straightforward. You would have to look at your health risks and everything else as a whole.
Yeah, of course. And that comes to like covering for insurances and stuff like that as well, which is very important.
Yeah, it's all
but I didn't
risk.
know. I would have thought, oh, you're nearly good, dead and gone. So what's the point? But you can.
Yeah. But and that is the point. Like some people can and some people can't. So my grandparents, for example, are over the age of 65, but did want to sell up and get a new mortgage, which they weren't able to do because of their age. So they were early 70s and obviously couldn't secure a mortgage because they were high. But back in the day, what I was going to say is pre-2008, you could get 100% mortgage. So you didn't have to put a deposit down at all. You could just start with that basis that, okay, cool, I agree, this is my income and this is what I'm going to pay back every month towards the mortgage. And they used to accept those offers, but after the crash, they didn't accept those offers anymore because it was too risky. So now that's why banks are looking for a higher deposit from you or a higher interest to show that you're here for the long run, because the 100% ones didn't really work out pre-crash, financial crash, that was crash.
As far as like doing mortgages on council properties as well, the discount that you get from the council covers your amount that you would pay for your deposit. You don't actually have to save a deposit at all if you are able to buy your council house. You get a discount from the council for the amount of years that you've lived in your house, and that covers your deposit in it. And then you get a mortgage on the rest that's owned. The rest, that's owed on the house.
Wow.
Very interested to know. Again, speak to a mortgage advisor if you are able to buy a council house.
With silence.
So another thing that I thought was good to mention as well on the mortgage front is the loan to value ratio. I know we've spoken about percentages of interest rates and stuff like that, and the banding. But it basically equates to what is the percentage of your, as I understand it, what's the percentage of your deposit compared to your percentage of what loan you're taking out. So if you're taking out if you're giving 10% deposit and taking out a 90% mortgage, then that would be your loan to value ratio effectively.
Yeah.
So yeah, and it's really important to look at. You asked about fixed and variable costs as well on your mortgage. So at the moment, because of the economic downturn, because of COVID, it's a really good time to get a fixed mortgage, as I understand it from loads of mortgage advisors, because the interest rates are really low at the moment from the Bank of England, which means your lender is likely to have a low rate going as well. So what you can do is fix that rate for a number of years. So it could be 2 years, 3 years, 5 years, for example. And then you know what your monthly mortgage payment is going to be every month for that period of time. The only downfall is you can't really remortgage or move to a different home, depending on your mortgage restrictions, before that period of time is over. But at least it gives you like the certainty of what you're going to be paying each month. Whereas with the variable, it might be a really low rate at the moment, and you'd have that flexibility about, you know, changing your mortgage and stuff. But if the rates do go up, so that they'll probably go up after COVID is over and we recover as a country, then your mortgage that you pay every month is likely to go up as well as interest rates rise. So it's really important to think about what would be best for you and what your like long-term and medium-term goals are with the property. So yeah, I think so.
Well, fuck you, chubby hoe. That wasn't in reference to her being chubby. That's just an old school joke that we used to have. Anyway, so Charlene's not with us anymore. So should we just quickly whip through? We didn't want to go into too much depth into any one area, but just more so a quick overview and insight into the mortgage process. Because as you said, it would be best to talk to a mortgage advisor or people at the bank just to kind of get an understanding of your own circumstances. Was there anything else important that you wanted to touch on, Aisha, before we kind of revisit and recap?
No, go for it.
The only thing I did want to hear from Charlene was about the self-employment mortgages, because I know there used to be a different process for them, but now my understanding is the process for self-employed people is exactly the same for those that are working in employment. So I don't think it's different, but it did used to be different. So that's something to look into if that's something that affects you or you're interested in. But yeah, just to recap, save your money for your deposit, save as much as you possibly can. And the more you put down, the better for you in regards to interest rates. That was your first point. I think when you know you're wanting to buy a property in the near future, again, revisit your credit score and your spending habits, because they will look into your pay slips. They will scrutinise your £2 lottery fees and stuff like that. So it's important to make sure that you're on top of those. Also, maybe we didn't mention this, but using the mortgage calculator. I'm sure you probably used it, Aisha. I know we did. And that's just something online so that you can kind of help yourself get an insight into what you can and could borrow. It doesn't necessarily mean it's set in stone, but it's something that you could consider. Also, the communication between you and the brokers and the agents, making sure that the solicitors are in place and that your money. So what you said, Aisha, about knowing that your fees, your stamp duty and your solicitor's fees might work alongside your deposit. So you might have 10 grand for your deposit, but you need to consider another 3 grand for solicitor's fees and another 3 grand for stamp duty, depending on what properties you're buying and whatnot. And the other thing we didn't touch on was buying properties together. So obviously, if you're both in a working position, you're going to get a better mortgage than you would if you're on your own. So if you've got someone that you want to buy with that you trust, whether it's a partner or a family member, that's definitely a good way of getting into the investment of a property if it's not just to live in, or even if it is to live in.
Sorry, just quickly on that, I know we're kind of wrapping up, but that's a really good point, and it's one of the questions you asked in the fast clock actually about that. About I can't remember what the question was, but anyway, I was just going to say it was about how many times your salary that you can take a mortgage out on. So obviously the banks do look at how much you earn, and then they base what you can borrow based on what you can earn and a multiple of what you earn related to what you can pay monthly. So obviously if you earn one wage, then you can get maybe 3 times your salary or 4 times your salary as a mortgage. But if there's 2 of you, you can get 3 or 4 times both of your salaries together. So actually, it does make sense to buy with another person because you can buy a more valuable home or a house that's worth more.
Exactly that. And especially when you are actually looking into properties, you'll find that what you can borrow probably doesn't get you far in regards to where you want to live or what you want to invest in. So if there is an option of a trustworthy partnership, then definitely look into that, because that would help you a lot more than maybe 150,000 or 200,000, and properties, depending on where you're living, usually and generally aren't that cheap. That's actually, it's a crazy world really, because you're not going to find something that cheap. So you are going to have to think smartly about what you do and who you do it with, basically.
Exactly. Yeah.
But yeah, so we covered looking for the house, something that's appropriate to you, speaking to the agent, speaking to the broker, getting the best deals, exchanging, getting your mortgage in principle, and then exchanging with seller, getting the seller to take the property off of the market so that it's hopefully just yours and less competition, and then legally actually agreeing to the contract and receiving your keys. And there's, Aisha, I don't know if you experienced this, there's something called chains and no chains. Was that on your property?
No,
Was yours?
so we didn't have a chain because it was probate, so somebody had passed away that was living in the property. So we were lucky enough not to have a chain, but having a chain, so that's either where you yourself have a property to sell already or the seller has a property to sell already. So either party or both parties need to find someone else to purchase their property or get a new property to go to. Which obviously makes the process a lot longer, because if there are other parties in the chain, each person needs to kind of go through that same process, and it all needs to come together at the same time. So it is quite complicated.
Yeah, no, I did want to cover that, because I know our property had no chains as well, which made it a lot quicker. So we were fortunate. But like you said, if there were chains, you'd basically be waiting on each individual party involved in that chain to complete whatever task they need to complete before the property is actually open, available to you to actually take.
Exactly, yeah.
So yeah, exchange contracts, get your keys, and then you'll have to pay your stamp duty, which will be like right there alongside your deposit. You'll have to pay your deposit, and then you'll speak with the bank about whose account it's coming out of and how much it is and stuff, just to recap on that bit once you secured it with your mortgage. I don't think we actually said directly, but you have to complete the mortgage application, which goes into your habits and stuff and like that, but that will happen. Yeah, and then move in with your no furniture because you spent all the money on the house.
Literally, no money to decorate it, no money to do it, to like buy your furniture and stuff. It's a lot more expensive than you envisage.
Yes, it's very expensive. So yeah, that's a really good point, because you're saving for your deposit, you're saving for the fees, but you might want some paint, and you might want some furniture, and you might have an idea of a kitchen or a bathroom, and it might need gutting out, or just those things to take into consideration. It's not going to just be, oh, here's my deposit and now here I'm off getting a house, because you can do that, but be aware that you might not want to live there.
You might be sleeping on the floor.
And they might be concrete floors that you need to put some kind of flooring down on, so be aware of that. But yeah, I think that covers what we wanted to cover. I think we've mentioned quite a lot of things that could be looked into further, so in regards to the self-employment, in regard to the fixed and variable rates, in regards to first-time buyer schemes, all those kind of things, definitely to be looked into. But we hope in some way, shape or form we've helped or given some insight. And, we might even add to the series. There might be something that we think about, Aisha, that we're like, oh, yeah, let's add that to the Level Up series.
Yeah, definitely.
Yeah, but for now, we out.
Oh, any podcast.
Podcast.